Hi, my name is Mike, and I'm the Chief Investment Officer here at Lighthouse Financial Services. And I'm here with the September 1st, 2022 edition of our market update. Let's get right into it, and I'll share my screen. Okay, state of the market. We'll go through a quick overview, what we're going to talk about today, and then I'll get into the details. We've had a stock and a bond market rally from about mid-June through mid-August. And the S&P 500 actually climbed 13% after bottoming in mid-June. But that rally seems to be petering out now. Same with the bond market. Bond market was up 4 to 5%, whether you're looking at corporates or even low-grade corporates, junk, or treasuries. But that bond market rally seems to be reversing as well. And I think investors are realizing that this normalization of the economy, of interest rates, of capital market valuations, this is a process and not like a 1 or 2 month event. And this process could go on another several months, or I don't know, 9 or even 12 months. So this is sort of starting to sink in with investors. The proximate causes, again, not much has changed here, but this bear market and this normalization is brought about because primarily high inflation needs to be brought back to normal, and the Federal Reserve is using tools at its disposal, like interest rate hikes, to do that. Unfortunately, this produces a lot of uncertainty, and that has really soured investor sentiment, and it's really taken down risk appetite among investors as well. I lined through the Russian invasion of Ukraine because a lot of the impact to capital markets and commodity markets specifically has reversed itself. So really, I'm thinking that the Russian invasion no longer has a hold on the oil markets, on commodity markets like food, agricultural products. So I've lined through that. Quick review of where we are with the economy. Now, months ago, this slide showed you that the Federal Reserve expected the economy to grow 3% this year and 2% next year. Well, I've been lining through those numbers because growth estimates have been ratcheted down this year so far. So the last time I appeared before you, it was down to 2.1% growth this year and 1.5% next year. Well, now the Fed has downwardly revised their economic growth estimates to 1.7% and 1.1%. So those are below what they call potential. Long-run potential. The economy, the Federal Reserve says the economy can safely and naturally grow at about 1.8 to maybe 2% a year going forward over the long run. So if we're saying estimates are down to 1.7 and 1.1, what that means is the Fed expects its restrictive monetary policy to have an impact and to pull growth down for a couple of years here. The inflation that's such a problem in this economy is definitely peaking this year. Whereas several months ago, the Fed thought it would peak at 7%, line through all that. Now it's looking more like it's peaking at 8%. Consumer spending was thought to be rising about 3% this year, and that's now estimated at closer to 2.5%. Still decent, by the way. But definitely, I think we can take away from this that growth is slowing. On the other hand, and we'll talk about this in a minute in more detail, labor markets are very, very strong, and still seeing positive hiring activity, and the economy is really not falling apart. Okay, so let's get back to the stock market, and this is the same chart I show you all the time. And we had like 100% correction in this, 100% rally from the bear market correction of COVID. but that gave way to this bear market again this year, 24% down for the S&P 500. But you can see there toward the end of the chart, we had a hook upward, and that's that 2-month rally, 13%, which seems now to be giving way. And bear market rallies are not unusual. You can be going through a tough time in the economy that may last for a couple of years, and capital markets won't do all that well, but there will be short periods where they do extremely well. So that's what we've seen here with the stock market. And I moved up the reality check slide right behind the stock market chart, because this is the proximate cause of the reversal of that rally in stocks and bonds. Last Friday, Jerome Powell, who leads the Federal Reserve, said in a speech that restoring price stability will likely require maintaining a restrictive policy stance for some time. Okay, so that means they're going to continue to raise interest rates until they think that they have reached a level where they can really start tamping down inflation. But then they'll keep them higher for a while just to make sure inflation does come back down toward their target 2%. And I think that was a little bit of a shock to investors who perhaps weren't paying close enough attention to the Fed before. The difference really being that interest rates not only are going to rise, but could stay at a higher level for a little while here. So let's talk about the path of inflation. It looks very much like inflation has peaked over the last month to 6 weeks. And you can see that here. The blue line is the Federal Reserve's preferred gauge for inflation, and that's clearly falling down from probably about 5.4% to about 4.5% in the last couple of months. And this other alternative gauge, the UIG that I look at, which they say is more inclusive of all the things that we actually spend money on in real life, that looks also to have peaked as well. So that's good news. No doubt, we've seen commodity prices come way down. I mean, the black is WTI crude oil, down below $90 a barrel. Remember, it was 120 when Russia invaded Ukraine. So that's great, because average price of gasoline in this country has come down quite a bit lately. I think it's come down from like $6 to $4.80 or something on average. So that's great. You're seeing agricultural commodities fall as well. So the commodities and goods, manufactured goods, those prices are clearly falling. Maybe not so much services yet, but we think that'll follow. So this is good news. I mean, the bond market, trading in the bond market will show you that inflation expectations, not just spot prices for today, but expectations are also coming down. And so over the next 2 years, the blue line here shows that the bond market as a whole expects inflation to average about 2.3% over the next 2 years. Boy, that's awfully close to the Fed's 2% target. In other words, it looks like not only is inflation starting to fall, starting to moderate, but the bond market is telling you it could come back within a couple of years to the Fed's target. So that's I think good news. Now, and yet, these are expectations for Fed interest rate hikes. The Fed's really talking tough, as I showed you in that slide. And recently, the bond market has had to sort of account for that. So short-term rates, maybe we thought earlier this summer that inflation would fall pretty quickly and the Fed could pivot or sort of not have to do all those rate hikes that they promised. And some of those expectations have sort of been disappointed by recent Fed language. So you see this expectation for rates coming back up to where it was in June. So it makes it hard for the stock market to keep going up when you have interest rate expectations coming up as well. I think over the last few months, we've all been worried about the coming earnings recession. In other words, if you're invested in the stock market, you really are concerned with sales growth and profit growth for the companies that make up whatever index you invest in. And for stock investors, earnings or profits, kind of the lifeblood, right, of those of stock gains over time. So we are watching this closely, and this is what I'm showing you here is just the results from second quarter earnings season, because public companies have to report sales and profit growth every quarter. And this is by sector. I'll just point out, you can see my cursor here, this is top line or everything together aggregate, sales growth of almost 14%, profit growth of 7%. What this shows you is, first of all, the world's not falling apart. Okay, these are positive numbers, most of them. But this sales growth, 13.7%, significantly higher than normal. That's just inflation. What that means is the companies are raising their prices for whatever it is they sell, and so that's why their sales are going up. On the other hand, earnings growth is much slower. So while it's positive, what this reflects is that input costs are up quite a bit. So inflation incurred by companies who make things or offer services up quite a bit, and that includes the cost of their labor, transportation, raw materials, all of that. So again, the world's not falling apart, but there are clearly some signs in here that inflation has been disruptive, clearly lowering profit margins for companies. And so, we may not see a full-blown earnings recession that's where you get a couple of quarters of negative profit growth. But clearly we're in for I think a period of slow growth. CEO comments. I always throw some of these in because CEOs will tell you most of the time, be honest, and tell you how their companies are doing. It can offer some great insight into what we should be doing as investors. So Marriott is first, and according to Marriott, their average daily room rates are back above pre-pandemic levels. That's if you've stayed in a hotel recently, you know that's true. And demand is very strong. And so the Marriott CEO said he's optimistic about the rest of this year. Now, the rest of this year is only several months, but still, I think that's a more optimistic message than you're hearing from a lot of other industries. Travel is still fairly strong. Affirm is the next one on my list. This is a newer company, and they focus on these installment loans, but they call them buy now, pay later, and they typically cater to lower end consumers. Anyway, they're seeing a small uptick in loan delinquencies, and they said, and this is a quote, there is some level of stress in customers with lower credit profiles. So I think inflation is really hitting different levels of society in a different way. So if you're relatively affluent, probably the inflation's not hitting you too bad, but on the lower end, it's clearly had an impact, a negative impact. So for a company like Affirm, that's a clear negative. Paychex does HR services and payroll services for small businesses all around the country, and they've actually been pretty positive. And a couple of comments here from the CEO recently. Small businesses are not showing strong recession signals, but hiring is slowing somewhat due to high wage growth. And so, the cost of labor growing at 5 to 7%, and unless your sales is growing significantly more than that, you're probably going to want to stall hiring or stop it altogether. So this is just the beginning, I think, of a slowing in demand for labor. But the CEO is also pretty quick to point out that in this country we still have 2 open job positions for every 1 unemployed person. So you're still facing a very, very tight labor market. And I think what the Federal Reserve is trying to do here is take out those unfilled positions. In other words, lower demand in the economy such that those unfilled positions, companies realize, well, I guess we don't really want to fill those. And yet your unemployment rate still stays low in the neighborhood of where it is 3.5% to maybe 5%. That's what they're trying to do. Anyway, there needs to be some slowing here, but we're not seeing much yet. Finally, Visa confirmed that consumers are still spending in a pretty healthy way. Payments volume, the volume of transactions on their payment network, that is, grew 11% from a year ago, but flat with July. Okay, so maybe consumer spending is flattening out a little bit, but is still a pretty good level. So let's go and visit the macro or the macroeconomic pros and cons here. And I want to outline again the bull case for the economy and investing and the bear case. So the bull case first. Look, inflation has clearly peaked. I show you some slides. It's really hard to ignore that. Inflation is slowing. Second, the labor market, we saw again today, you may have read my morning update. Jobless claims remain pretty low. That's claims for unemployment insurance benefits, really historically pretty low. And we're just not seeing the wave of layoffs that I think the bears expected a couple of months ago. Finally, global supply chains are clearly healing, and consumer spending should prove resilient. It has been pretty healthy so far. The bear case is this. Okay, yes, inflation, and I'm going to skip to the bottom bullet here. Yes, inflation is slowing, but it's going to take a while to subdue, and it will moderate very gradually, and the Fed is going to have a hard time getting it back to that 2% target rate. That's the bear case. Back up to the top of the bear case, growth is clearly slowing. That is, again, hard to debate. The Fed doesn't necessarily have a great track record in engineering soft landings. In other words, they raise interest rates, but because there's a policy lag, there's a lag between them raising interest rates and the actual impact to the economy. It's hard for them to really be surgical. So they might end up going too far, and sometimes that does happen. And what happens then is that they drive the economy into a recession. Next, after the recent bear market rally, stocks and bonds aren't really cheap. They might have an argument here. Stocks and bonds probably need to cheapen up a little bit. It's our view here that bear market rally wasn't really warranted, and so they may have a point. And finally, they say real wages are falling, and this could hurt consumer spending. And this is the inflation argument again. So we at Lighthouse here are right in between these two positions. Look, inflation is clearly peaked and it's slowing. Growth is clearly slowing. That's exactly what the Fed wants. They're trying to slow economic growth without driving it negative, and they're trying to bring down inflation, and that seems to be happening. But as I've said before, all of this depends on the pace and the path of inflation. Does it get subdued quickly or sort of more gradually? And also how the Fed reacts. And those are two huge unknowns. Right now, the economy is in okay shape, and things, I think, from a Fed perspective are going sort of to plan. Okay, so reason to panic? No. And that's part of the reason why we're in between these two cases. We don't see why inflation has to be sticky and has to stick around for years. On the other hand, we're not absolutely sure that that the Fed can engineer a soft landing. This could be what we've called in the past kind of a bumpy landing. And so, I noticed some hesitancy among institutional investors, even the brightest economists and strategists that we pay attention to, there's a hesitancy to sort of call the bottom on the stock market or the bond market, or when does the economy quit slowing, and when does the Fed pivot. And I think that hesitancy really comes from an uncertainty, and that's not going to end anytime soon. The one thing you can bet on with regard to a period of uncertainty is greater volatility. So we expect through the end of this year just a bunch of bouncing around. The stocks and bonds, by the way, are going to bounce around, and so will commodities. And because this, as I said before, is a process. Chris Heisey he's a chief investment officer over at Bank of America / Merrill Lynch. He recently said that look, there's a lot of uncertainty in the economy and how the Fed's going to react, inflation, as I said, and so you have to view this as a process. It's not an event. It's not something like COVID where you get a vaccine and everything's healed and the market snips it out and it's just a V-shaped recovery. It's not that. So we're looking at staying with quality investments that can weather the storm, and maybe sitting on a little extra cash to be opportunistic. He says it's okay to get a little bit defensive here, but you don't want to throw in the towel because any good news at this point with the market down could be greeted with a spring load higher. That's our market update for September here. We if you care to look at our disclosures, there they are. I want to thank you for watching and listening, and we'll be back in about another 30 days to give you some more. Thank you very much.